This week's theme on the Retirement Quick Tips podcast is, are ultra low interest rates gone for good? Today, I'm talking about how to invest in this type of environment. So today I'll talk about how to invest in bonds. Tomorrow I'll talk about how to invest in stocks. And then after that, I'll talk about some other decisions you might want to be thinking about as it relates to other areas of your personal financial situation, like whether or not to buy a house and move right now. Okay, so today we're talking about how to invest in bonds. Now, the first thing I want to mention with investing in bonds is that quality matters. Quality matters at all times, but especially right now in the face of higher interest rates. If you're going to buy bonds, the highest quality bonds you can buy are treasuries, followed by municipal bonds. But municipal bonds don't make sense for a lot of people unless you're in a really high tax bracket. So that leaves CDs, which is also, I'd put it on the same level as treasuries as far as quality, as well as high quality or investment grade corporate bonds. Okay, so you don't want to be investing in high yield bonds. You don't want to be investing in junk bonds. And the primary reason for that is that in the face of higher interest rates, if you think about running a business with higher interest rates, if you are a debt-free business, which most businesses are not, you need to go out and raise money. Some businesses even rely on debt and short-term financing to make payroll. Okay, these are not the businesses you want to be investing in a higher interest rate environment, because higher interest rates creates financial distress for businesses. And lots of businesses are experiencing financial distress right now. So it is estimated that anywhere from like 10 to 30% of publicly traded companies, businesses in the United States are what's known as zombie companies. Now, 30% is probably on the high end. Most of the estimates I've seen peg it around 10%. So let's just go with that. Let's say 10%, 1 in 10 companies publicly traded. So these aren't like mom and pop. These are large US businesses that you could buy bonds from, you could invest in. 10% of them are zombies. So zombie companies are exactly what they sound like. They're not really alive. They're limping along. They rely on cheap financing, and they are usually laden with debt. So they used to be able to hide in plain sight when interest rates were much lower, but now that the debt costs are much higher, many of these zombie companies, they're no longer able to generate enough cash to cover their operating expenses, their costs, and their interest payments. So what's been happening? Well, corporate bankruptcy filings soared last year. They were up 19% in 2023 from the previous year. And already in the first quarter of 2024, there were 120,000 total corporate bankruptcy filings. And that is a 14% increase from the same time last year. So you had a huge jump in bankruptcies last year, another huge jump again this year. And so businesses are really struggling in the face of higher interest rates, which if you listened yesterday, I talked about how the economy is so resilient. And a lot of that is because of the consumer. And we're still spending. The unemployment rate is still very low. But many businesses are struggling in the face of higher interest rates. So you want to make sure that when you're buying bonds or bond funds, you're sticking with quality first and foremost. Financing costs, they're not going down for businesses anytime soon. And the longer that this continues, more and more companies are breaking under that financial pressure. The other thing too is banks are very tight on their lending standards. So a lot of businesses who need access to capital and maybe could pay that back, the banks are just not lending money in this environment. So other than quality, the other mistake that I think people are making right now and that you want to avoid is don't be complacent sitting in short-term money markets, high-yield savings. You're earning around 5% right now in those short-term money market, high-yield savings accounts. But historically, the best time to invest in bonds is before interest rates start going down. And so it seems unlikely right now that interest rates are going to go up from here. They might go up a little bit, but they're not going to go up dramatically from here. I don't see how that's even possible. So you could be waiting months or years even for interest rates to go down meaningfully. But if you're collecting 5% on your money markets, you don't want to miss the opportunity to lock in that 5% in longer term rates, because this is the most attractive interest rate environment we've seen in the last 20 years or so. So right now you can lock in a 5% rate all the way out to 7 to 10 years. Okay, think about that. It's more complicated than that. If you need money in short term for that's earmarked for something or you have emergency savings, fine, keep it there. But if you're just putting money in a money market because it's paying you 5% when it could be earning 5% elsewhere, now is the time to be locking in rates. I prefer to do this via a bond ladder. It removes a lot of the guesswork in investing in bonds when you don't know the direction of interest rates. Also, the yield curve is pretty flat right now, which means you can get about the same rate on a 1-year bond as you can get on a 5, 6, or 7-year bond right now. I like CDs for especially the first 3 years of that bond ladder. The rates are pretty comparable to corporate bonds, but you have that safety factor. And then, if you extend that ladder out 5, 6, 7 years, you can lock in rates for much, much longer. And the likelihood is that rates will go down, maybe not dramatically. Again, the whole topic of this podcast this week is it seems unless something really cracks in the economy and we go into a recession, probably will be until the next recession before rates meaningfully go down. So that could be several years. I wouldn't be comfortable going out maybe past 5, 6, 7 years. But if rates go a little bit up, you might see the value of your bond portfolio go down a little bit. That tends to be more at the longer end of the bond ladder too. So you want to avoid going out too far, because if you're wrong, or if I'm wrong about the direction of interest rates, you don't want to suffer in your portfolio by having a decline in your bond values. Okay, so if you're not familiar with a bond ladder, but you're interested in this strategy, I have talked about it previously many times on the podcast. I just don't have time to go into it today. You can search the episode archives, or you can just Google the term bond ladder and you can learn more about it that way. But I think it's an excellent opportunity to start laddering some bonds right now, locking in rates and getting out of money markets in general. All right, that's it for today. Thank you so much for listening. My name is Ashley Mitchkay, and this is the Retirement Quick Tips Podcast.